Good morning. Good morning and welcome to the presentation of our interim results ended 31st of December 18. I'm also joined today by Kiran Futter, our CFO. Thank you for taking the time this morning to come and see us, and also welcome to investors and other stakeholders who are with us online via the webcam. I would like to send a special thanks also and welcome to our Ascendis Health employees who are also with us this morning via webcam. I would like to thank you for your passion, energy and commitment during the last 6 months. You have shown an unbelievable resilience. You showed up for challenges despite headwinds at times. Thank you. So this morning we will share the journey we undertook over the last 6 months, including operational reviews and details on the financials. We'll also show you where we are in terms of strategic focus, priorities for the second part of this year, and leave you with a reminder of the value of the business. First, a quick overview, and let's take a step back. As we presented back in September last year, the business required strategic and financial interventions to deliver sustainable value to our shareholders. I also remember that we said it won't be a sprint. The last 6 months have proven that. We've been making a lot of progress in a very challenging environment, especially here in South Africa, but also been dealing with unexpected obstacles like any business. We launched our new strategy. We rapidly progressed into some design work in our operating model and started to work towards a phased implementation of that new model that will create more synergies and also give us much more competitiveness in the market. We also announced the divestment of biosciences, and we are now at a very advanced stage of disposing 3 of the businesses. We really never talk about the share price, but I have to mention again, and you have seen it, there was a steep decline in our share price over the last months, which also created a rather negative sentiment in the market. It was not a result of any new news from our side or any operational issues, but it did limit, however, our room for maneuver. Despite not getting the bond away in November due to market conditions, we now have a plan how we'll resolve our capital structure, which we'll show you later this morning. A few months back, we received an unsolicited offer for our business in Europe, America, which the board decided to explore further. And we are still in ongoing negotiations, and we'll give you an update later on that as well. With the latest in mind, we did have to pause the implementation of the operating model of our new strategy. But we are still working very hard on our 5 big priorities that we also presented back in September. The group top line is up by 3%, driven by Europe after 6 months. The group EBITDA is only growing 1%, which is hampered by a decline here in South Africa at 7%. We're also proud to announce that our cash flow conversion actually was up more than 50% versus last 6 months. So we're not happy with the result as such, obviously. We want to go for much better. But there are many areas of very pleasing progress which we're going to show you and share with you. And we know where to improve and to deliver on our long-term committed targets. Let me hand over to Kiran, who will take us through the financials.
Thanks, Thomas, and good morning, ladies and gentlemen. Before I delve into the numbers, I'd just like to extend my gratitude to the group finance team and all the other members of the finance and group team who helped put this presentation together, as well as all the finance managers and managing directors in all our businesses across the globe. I think I need the clicker. So looking at our revenue growth for the last 6 months, we see reported growth of 3%. 2% of that is due to the Chiron acquisition, which we made back in March 2018. The EU reported growth of 7%, but on a comparable basis, this is 8%. A large part of that has been boosted by the weakness of the rand that we saw versus last year. And on a constant currency basis, the EU businesses actually grew at 4%. So we can see how the investment into Europe has provided a very good hedge against rand volatility. The one small change as well is that we now see that the EU revenue represents 50% of our revenue, total group revenue, which is up from 48% this time last year. Looking at our new segments, so with the change in strategy that we announced back in September 2018, we now show two additional or new segments, being medical and animal health. Both of these are South African-based businesses. As you can see, medical has had a tough year. They had a fantastic year the year before, so they're growing off quite a high base, but they've had a tough 6 months driven by cash and some supply issues. The animal health business that we can see is showing fantastic growth numbers, but again, that has been boosted by the acquisition of Chiron Labs. As expected, we see some pleasing growth in our bioscience division, 4% on the top line, 10% on an EBITDA level. And this is as expected because we have seen our agri-businesses starting to recover from the drought, although we still see some water restrictions which have been hampering our consumer-facing business, which is our domestic gardening business, which you may know as Effecto. Looking at our income statement, the pleasing thing to see is a pleasing increase in our gross profit margin, up to 45%. The three main drivers of that are the implementation of some of our strategic objectives, and that was a drive to discontinue low-margin products and invest our marketing spend into higher growth and higher margin products, so we're starting to see that come through already. We've also had some upsides from some effective hedging and price increases in the market, and the acquisition of Chiron has also helped boost that number because they have very healthy GP margins. From an expense growth point of view, we see some one-offs that we experienced from restructuring, and that was in the bioscience division. We combined the Maltons and Effecto warehouse up here in Joburg. We also had some costs that we incurred when we prepared for the high-yield bond, legal fees and credit rating agency types of fees. And what we've done consistently is remove the operating costs for our Sando factory. We did that last year and this year, just to show you a normalized EBITDA number. Looking at the rest of the growth, of that 15%, 2% is related to the acquisition of Chiron, and the rest is due to an increase in marketing, sales heads, and distribution. So overall, we've seen the EBITDA margin kind of remain flat versus last year. Looking at the rest of our income statement and the reconciliation between our earnings and our normalized earnings, we see an increase in our finance costs driven by higher debt levels, predominantly in Europe, but our interest cover still remains fairly robust at 3.6 times. What we have done is we have removed, in our capital items, we've removed the profit that we made on the sale of our Sando business. That came through late in December. And we consistently make adjustments to our normalized headline earnings where we add back costs which relate to restructuring, to capital raisings, to debt raising, as these are not operational costs as we see it. And then we also add back the amortization on our intangibles in line with our peers, as in our opinion this is purely an accounting charge and not a cash flow impact. Looking at some of the discontinued operations and the restatements that we've made, this is similar to what we reported back in September. So last year we announced that we would be disposing of our sports nutrition business and our direct selling business. The sports nutrition sale was completed back in September 2018, and we're still busy in the process of selling our direct selling business. We also announced the desire to reduce our fixed overhead base and better utilize our capacity, which we acknowledge was not running at optimum levels. We want one world-class facility instead of multiple dispersed manufacturing facilities. So we set out and to sell our Sando factory, which we did and completed in December. Fortunately, this sale does not qualify as a discontinued operation under IFRS. So what we've done is we've normalized the impact of that loss that we incurred on that, both in this year and last year, just to give you a view of what the business looks like without Ascendis. So from 1 January, we'll have no more fixed costs related to Ascendis in our numbers. The restatement that we see there relates to an elimination of profit on intercompany sales, so the profit element in the stock figure that was on hand, which was not done in December 17. We moved on to a new consolidation system in May 2018, and this is now done on an automatic basis going forward. Capital management. As a fairly highly leveraged business, cash generation is very important to us. There is an element of seasonality in our H1 cash generation results. The main one being the impact of the European summer holidays. The Remedica, Sunwave, and Cytec businesses basically closed down almost in July and August. And the build-up for the planting season in our bioscience business back here in South Africa. But it was pleasing to see that our cash conversion increased to 73% from 46% in H1 2018. Looking at our CapEx, in line with the guidance that we provided, it's about 5% of our revenue. 50% of this was for necessary compliance CapEx initiatives, mainly in our European businesses, where we had to comply with the new EU legislation around serialization. The other 50% of the CapEx relates to future expansion, mostly in the development of new dossiers and marketing authorizations, as well as equipment back here in South Africa that we place in hospitals in our medical division, where we sell consumables into. The deferred vendor payments that we see here relate to our 3 most recent acquisitions, namely Chiron, Cipla Animal Health, and Sunwave Pharma. The other investing activities relates to the transaction for the sale of our Sando factory, the proceeds of which we actually received on the 2nd of January in this year. Our cash position was also somewhat depressed by the bond raise costs and some of the hedges we took out to hedge against the long-term incentive plan that we launched back in July 2018. This was an incentive to attract and retain key talent and was launched across the group for all senior managers and leaders. Looking at our net working capital, there's been a lot of focus on working capital management across the group. We are pleased to see a decrease in our net working capital as a percentage of sales versus prior year. So we see 33% versus 36%. And this has contributed towards the higher cash conversion metric of 73%. The biggest movement in net working capital versus June of last year, as we can see here, is our inventory. And this is driven partly by the seasonality, so build-up of inventory for the planting season in our bioscience division, and somewhat by the lower level of sales that we experienced in our consumer South Africa division because of some labor issues being experienced by one of our bigger customers back in December. Looking at our debtors, we've spoken quite a lot about government debtors this time last year and in June. In our debtors figures, we're carrying about 70 million related to the Gauteng Department of Health. We were one of the few suppliers to receive an actual acknowledgement of debt for that figure, so we have been carrying that figure for a year on the premise that they pay us within 30 days, which they've stuck to thus far. Despite carrying this debt for over a year, we have seen a decrease in our debtors days versus last year. And then our creditors, our trade creditors. In SA, we have experienced some liquidity issues, and as a result have had to negotiate longer payment terms with some of our suppliers. We expect this to be resolved in the next quarter once the government pays all the money that they owe us that we've carried over from May 2018. This normally happens when they get their new budgets in April and May for their new fiscal year. Looking at our gearing, our net debt to EBITDA ratio has increased to 3.9 times. This is still below the covenant of 4. 70% of our debt is denominated in euros, so we saw an uptick in this metric because of the rand weakening, and we extended some of the EU debt facilities. The slight delay in receiving the proceeds from Ascendis also contributed to this increase. And we had to extend our debt facilities during the year in order to service our deferred vendor payments. It is pleasing to see, though, that our total cost of funding has decreased to 5.6%. Looking at our cash commitments for the next 6 quarters, you can see that the majority of the cash commitments relate to deferred vendor payments. The largest one being Remedica, which is about 40 million euros. We expect this to be resolved as part of the ongoing sale process or as part of the refi process that I'll talk about a little bit later. We have been successful in deferring 2 of the other deferred vendor payments, the main one being our put call option for Pharma Leader. We would prefer to buy 100%. We are due to buy 31% in terms of the original SPA. We'd rather buy the remaining 51%. Our preference is to have full ownership because this enables us to execute our strategic objectives faster and more effectively. I'll now hand back over to Thomas. Thank you very much.
Okay, let's have a quick look overall at the revenue progress within the businesses, and I'll also take you through the EBITDA. And we're looking at this at a comparable basis versus the previous half year. You can see internationally we're growing 8% in rands and 4% in euros. Sunwave is still growing very, very well, 20%, whereas Remedica and Pharma Leader is slowing a bit in their growth, and it's single digits. We have still not turned around SciTech, as you can see, though we have slowed down the decline to 5%. I'll come back to SciTech a bit later. South Africa is down versus a year ago by 5%. The positives here, as Kieran mentioned, are biosciences and animal health. Group-wise, we're growing 1%. In terms of EBITDA, we're growing 11% internationally in rands and 7% in euro. And as you can see, all businesses except from SciTech are doing very well when it comes to EBITDA, growing well ahead of the revenue. In South Africa, we cannot be satisfied with a decline of 11%, obviously, which is driven by pharma, medical devices, and consumer health. Also here, biosciences and animal health are growing. Group-wise, we are down by 1%. Let's quickly go through the various businesses. And as you can see, we are again doing this very openly, very transparently. We're actually showing you a lot of details for each of the businesses, which I hope you appreciate. Let's take a look at Remedica first. It is growing its top line by 5%, which is a slowdown versus the previous year, the previous half year as well, which was a fantastic first half year for the business. But due to strong cost management, you can see the EBITDA is growing faster. The growth is driven by current customers, and out-licensing is still outperforming the rest of the business. The slowdown is actually caused more by internal technical issues, regulatory issues, and also some supply challenges we have had. And we've also been facing some political instability in some of our key countries in emerging markets. We expect most of those to be resolved, those that are within our control, in the second part of the year. And here we're also looking for a new pricing model, because obviously pricing and how we go about pricing is very important for the business. So we're going to add a lot more intelligence to the way we deal with that. Pharma Leader, the business where we own 49%, is growing 3% top line. And we are now starting to see EBITDA also be in the zone where we want it to be. And this is also driven by a new supplier strategy that did hamper us the previous 6 months. Happy to report that probably one of our best innovations there, sildenafil, also got some patents in new countries, including the US. Doesn't give us revenue now, but definitely in the future. And we've seen great progress in terms of new customer agreements for our focus products. In the second part of the year, we had to increase our customer footprint via faster expansion and also getting our products within each customer. So a lot more depth in our distribution. We also expect to close new licensing agreement with some multinationals in Europe. Again, won't impact the revenue straight away, but will come in the future. Let's take a look at pharma here in South Africa. So you can see a decline here, which of course we are not happy with. It's mainly due to Indian supply issues, which are mainly regulatory driven. Also, we made a conscious decision not to apply for low margin tenders. On the private side, we can see that our new portfolio management strategy is working, and the OTC brands in that sector is actually doing very well. And we expect a lot more from them also in the second part of the year. And in the second part, we will focus on recovery of the government debt and certainly harvest the great work we're doing on the brand development in that space. Medical devices. You might recall that last year we did enjoy high-level growth, double-digit in medical devices, at high margins due to the equipment sales on government tenders. This business is a great model, has a high return on investment, but it is working capital intensive. As reported, I think also previously also mentioned by Kieran, we have experienced delay in collecting a material portion of the debt, which in turn led to supplier issues by the major principals. Many of these suppliers are on prepayment, and as we have outstanding payments from the government and the business require a high level of stock, we weren't able to fulfill all these orders in time. Our EBITDA drop was impacted by Forex and also training of new personnel in one of our new agencies. And we decided to keep focusing on that because it's obviously going to help us with the future growth. In the second part of the year, we are accelerating the backlog of our orders and completing the integration of our new offices. Now to consumer healthcare in Europe and Cytec. It's clear that we haven't turned around this business yet. However, we are still sticking to the 5 stabilization strategies we are putting in place in that business, because we do believe that's the right thing to do, improve the value, underlying value in Cytec. We saw a drop in decline from -9 last year to -5 those 6 months. It is encouraging, though, that the volume is also flat, but it's a very competitive market, as you all know. So that has put our pricing under pressure, and we have lost out on value. Amazon is still growing in all our markets, and our new key countries where we decided to really focus our efforts and investments, such as Germany and the UK, are growing again. In the second part of the year, we're going to test launch our new sub-brands. We want to test and learn before we really expand and invest into those in more markets. Our contract manufacturing, I think I mentioned last time, is paying off, and we want to accelerate that growth in that channel also in the second part. It's actually doing very well, also for our efficiencies. We said in September that we'll give Cytec another 6 to 9 months before we can conclude on whether we have built the value to turn it around or not. And we believe a natural decision point is when we are going to revisit our strategy pending the disposal of Remedica. If you want to dive more into the progress on Cytec, you'll find a one-pager in the booklet which talks a lot more about the details on the progress of the business. Sunwave is still flying. That's the Romanian business. Both top line and bottom line, 21% at top and 38% at bottom. The HCP, so healthcare professional go-to-market model, is unchanged. We're getting more learnings, we're fine-tuning it more, and actually the team is becoming a lot more sophisticated. So it's a great model. The consumer and pharmacy model that we launched last year, which is about 10% of the business now, is also working and complementing the HCP strategy to build incremental growth in the business. So here an overview of the consumer healthcare business here in South Africa, which is the wellness business, the skin business, and our Weinberg supply business. During the first 6 months, the wellness business was again hampered by own supply issues initially in the first 6 months, and also some labor issues at Dischem that hampered our infill. But in the second part of the first half year, we start to see our infill rates go up across all channels. Our new sub-brand, Solar Restorix, which consists of 7 unique variants, you might have seen them here in South Africa in pharmacies because we've got a lot of space in store, are doing very well. They also boosted the overall Solar brand. And we have high expectations for this range, also in the second part of the year. The skin team is focusing on leveraging our Solar skin brand, which is up more than 50% versus last year, and that taps into a very unique consumer insight. The salon market is under pressure in South Africa. Salons are closing, so we are working on increasing the consumption by salon, obviously, to keep our business. And we'll continue the expansion into the UK, which is also working well. It's up 40% versus last year. And we're launching our new brand, H12. More mainstream, a distinct brand, and we launch it online here in South Africa. A key priority for the second part of this year is finalizing integration of wellness, skin, and our Weinberg supply into one consumer healthcare division in South Africa. That will make us a lot more competitive, and also we're going to gain a lot more efficiencies from putting them all together. And finally, biosciences and animal health. Very pleased with the top line and bottom line and progress of biosciences, despite the ongoing sales process. Kieran talked about some of the reasons, including the recovery of the drought. And the second part of this year, we're going to maintain the same levels, while we expect to close the bioscience disposal of 3 of the businesses. Also proud of the animal health growth. The AgriMed team have produced an excellent new range, which is now paying off within vaccines. The Kyra integration is producing the synergies that we promised for the total division of animal health. The slow EBITDA growth that you're seeing up here is caused by disproportionate uptake from lower margin products in the compounding segments, something we of course will address in the second part of the year. And we're also investing more into this business than we were previously. Let me give you a quick update on the group strategy, and I'll be joined by Kieran when we come to the refinancing part of it. So let's start with a status on the strategic implementation process that we launched in September last year. As I said earlier, a great deal of excellent work has been undertaken already, and there has been a lot of progress in implementing the strategy. As you might recall, we developed this new strategy complemented by a new purpose and a new vision, underpinned by 5 strategic priorities, and everyone across all divisions are working on. We expect that the design work and the implementation of the work will be implemented and completed by Q3, and this would be followed by a progressive phased implementation. All the BUs are aligned to the 5 priorities, and it's also a part of their plans for 2020. In that way, we can oversee the total business, we can look for synergies, and we can help one another across the BUs. So while we were disappointed that we had to pause parts of the implementation of the operating model in light of the Remedica offer, it was clear we had to do that. A successful sale of Remedica will have significant implication on our strategic direction as a business, because Remedica is at the core, and we believe it makes sense to relook at the strategy, the focus, once we are clear on the outcome of the process. It might have implication for our core proposition as a business, the categories and market where we play, and how we are structured. Of course, we are prepared for strategic review should the sale be successful. On the divestment front, a lot of things are happening. Let me first announce that we are on track on our disposal program. The smallest of the remaining disposals, direct selling, has not yet materialized with the original interested party. But we are in discussions with another party, and we expect to close this the soonest. We successfully concluded the sale of Isando of 128 million, and expecting the final amount of 28 million to come in April, just subject to a few regulatory matters. Negotiations for Effecto, Moltons, and AfriCelp businesses within the biosciences, as I said earlier, are at a very advanced stage. Avima and Club 5, the two remaining businesses, will be considered for disposal in the short to medium term. But it's two completely separate transactions. Negotiations regarding Remedica are ongoing. We have appointed an advisor, and we also extended the process to include other bidders. The process is going as planned, and once we have new news, you'll hear from us immediately. I also wanted to just pause on South Africa, because as I said earlier, we can't be satisfied with the performance. We know it is a very challenging market, generally, but what's in our control, we need to improve. We need to continue to strive, of course, for revenue growth, organically that is ahead of the market. And we believe our new portfolio strategy, which is coupled with our brand work, consumer work, and reducing the tail and focusing on the brands and products that can win with customers and consumers, is the right thing to do. We can see it's working now. Also, margins are improving. And I can say the marketing teams across the BUs, including other colleagues, have taken this to a new level already. To drive the effectiveness internally and being a lot more competitive, more lean and mean and agile, as I said earlier, we are combining the three subdivisions of consumer health in South Africa. We have kicked off a cost effectiveness program and will also be assessed in light of potential new strategy. But we are cost conscious and we are cost focused. We have a cash task force in place that are working daily on all the cash conversion lead indicators that we all as a team review on a daily basis. Cash is really at the forefront of every leader in the business, and this task force is doing a fantastic job here to help us. And finally, as I mentioned in September, we do have capability gaps. And one thing we are going to do eminently, it is to focus a lot more on our finance reporting, strengthen that to enable stronger performance also in South Africa. So I would say this is a short list. We're doing a lot more things, but this is going to help us here in the second part of the year as well.
Thanks, Thomas. So back in September, we announced that because of the large cash commitments that we had coming up in the 2020 financial year, that we needed to review and optimize our capital structure. We prepared to launch a high-yield bond, which involved obviously obtaining a credit rating and preparing an information memorandum. That process went very well, very smoothly, lots of work involved. I must say the ratings that came out were as expected. Although at the time, we decided not to launch the bond on the advice of the banks that were assisting us in that process. It was felt that because of the rise in the US interest rates, as an emerging market debut issuer, they felt that we shouldn't go into the market and rather wait for the market conditions to improve and give ourselves a chance to potentially go back into the market at a later stage. We have therefore appointed the debt advisory team from Ernst & Young, based in London, to provide an independent review of our capital structure and make a recommendation to our board, which they have done, and then to help us execute that recommendation. A number of potential solutions were considered during that process, and we felt that, well, the recommendation that came out, that getting support from our existing lenders through a refinance process was the best way forward. During these discussions, we once again articulated the strengths of our business and provided a key summary of events that got us to our position today. So apart from actively pursuing our divestment opportunities that Thomas mentioned earlier, we also continue to engage with potential investors and other stakeholders as part of exploring all the different solutions. For the short term, we are very confident that we will reach a positive conclusion in terms of the support that we have asked our lenders for. And in the longer term financing project, we'll work on this project in process with the Remedica disposal. Thank you.
So let's leave the group strategy, and we're almost at the end. Just a quick recap on our priorities for the second part of the year. Obviously, we're very focused on improving our organic revenue and EBITDA growth, as well as cash conversion. But those are the outcomes of all our work. So what we're going to be even more focused on are all the lead indicators, all the work behind that is going to get us there. We'll consistently address all the areas of underperformance in South Africa. And as I said earlier, we'll come back with a clear decision on Cytec. But we said also that we want to put in the right building blocks before we make a final call. Improving the health of our balance sheet and optimizing our capital structure is a key priority, as Kieran just took you through. Completing the transaction of Biosciences and progressing the Remedica divestment are major priorities in the next few months, left of this 6 months. Should Remedica be sold, as I said, we'll revise our group strategy and build on the strengths we have and what we have achieved so far as a business. Before we close, I wanted to leave you with this and just remind you of what we also presented less than 6 months ago. Even though we have short-term challenges as a business, and we are focusing on our H2 key deliverables, we should not forget the inherent value of this business. The business model we presented back in September, which you see up here, delivers this continual growth and value creation via our 5 strategic priorities. I know it's a simplified model of what we're doing, but it actually works already, only after 3-4 months of implementation. Despite the revenue decline here in South Africa and working capital issues, we've seen a positive margin expansion already, which is a part of the model. And also cost optimization programs are now put in place, so we can reinvest in the business. The market cap, I think you all know, is far lower than the latent value of the business. I'm sure you're doing your own calc. So it's our number one priority as a business to maximize value, and whether we divest Remedica or not, we'll have a strategy to maximize that value. The long-term financial targets we set out in September, we're not running away from. We are committed. And as I said, when we laid out the foundation for the strategy and the rationale behind the strategy, it was never going to be a sprint. Thanks for your support, and thank you for your attention this morning. We are now happy to take your questions, and Kieran will join me up here. Thank you. There's a question down here.
Thank you, Mr. Thompson. Mr. Thompson, you've been quite frank about the health of the company and the difficulties you're facing. But for all that, some questions still need to be asked. Your balance sheet, for instance, shows that in the last 6 months, inventories are up 238 million. Trade and other payables are up just over 200 million. From your income statement, compared to a year ago, selling and distribution costs are up 16%. Admin expenses are up 12.5%. And other operating expenses are up 25%. So what action has been taken in the last 6 to 12 months to remedy these issues, which certainly have not gone any way to strengthening your balance sheets?
Yeah, I'll take that question. I think we did cover some of these issues, but I'll reiterate. So from an inventory point of view, the increase in inventory, we expect a seasonal increase in inventory, particularly in the bioscience division. We build up inventory as we sell into the planting season. So typically, you'll see our inventory increase, and then our debtors, as the sales go into debtors, and then we start receiving cash in quarter one of the 2019 calendar year. Obviously, when you see inventory increase, trade and other payables also increases in line with that inventory increase. In terms of the income statement queries you raised, selling and distribution, as we said, part of the strategic initiatives was to increase heads, particularly in places in our consumer businesses like SciTech. We increased heads, and we can see the effect of that on the top line in that business, as well as an investment into distribution. The admin and other operating expenses, a lot of that has been sort of tempered by the once-off costs that I mentioned. So the preparation for the bond were quite substantial costs that we included as a once-off, and we have added back those costs as part of our normalizations. But I think Thomas also covered, in terms of the business model, how we're actively addressing those in terms of our cost optimization programs that we've put in place and continue to put in place going forward.
Would you allow another question, please?
Sure.
There's a detailed explanation at note 5 on page 23 of the report regarding intangible assets and goodwill. And if I may quote from one paragraph, you state that the group share price has decreased significantly over the last 6 months, and the group therefore performed impairment assessments on all goodwill balances as at 31 December. I've had a look at the two tables in some depth, and the only impairment that I can find out of the 9 segments listed is the one relating to consumer health. Now, in fairness, there is another table overleaf on page 24 which gives details of certain calculations made, which regrettably I haven't had time to study just yet. But how is it that, given your concern about the goodwill, that only one was assessed downwards?
Yeah, I think Thomas also addressed that in his opening statement. So we have seen a marked decrease in the share price, which gave rise to the need to look at the impairment tests. I think we see this, the source of that share price decrease being forced selling by a major shareholder, and not as a result of any major issues with the operating activities of the business.
Thank you.
Yeah.
Can you comment on the relationship between you and Coast to Coast and the fact, I think, that they've been a seller and they, is that one of the reasons for the share price weakness?
Yeah, I mean, we have seen the forced selling, and that had an impact on the share price. As I said earlier, we don't believe it was caused by operational issues. We haven't shared any new news since our results in September last year. In terms of relationship, we are, and as I said also in September, we are keeping an arm's length relationship with them. They have a board seat, and we make all decisions in the company at the board level. And that's what we're doing every time we're together as a board.
Ian Cruikshanks, Institute of Race Relations. I'm looking at the slide review of capital structure, in which you go into some details as how you're going to raise capital. Initially, and also including a look at the high yield bond. The fact that it's a high yield bond, is that an indication that it's seen as relatively high risk? Otherwise it wouldn't have been classified as high yield. And are you, the fact that it was withdrawn, was that because of your borrowing limitations, or was it in fact just market conditions? If it was market conditions, surely then the issuing bank didn't judge it very well initially. Can you comment on that, please?
Sure, I can. Yeah, so you know, high yield bond market or emerging bond market, either in the US or EU, was what we wanted to do. We wanted to launch a bond into that debt capital market. We prepared for that bond. We did the ratings. We had 3 major global banks assisting us with that process. And they felt that as a debut issuer, if we didn't have 75% chance of success, we shouldn't go into the market at all, because that would compromise your ability to go to the market at a later stage, because that would be seen as a failure. So we didn't even enter or start marketing the bond any bank or to any investors at any time. And that's the position that we're at. So it was unfortunate because we had fully prepared for that bond. It would have resolved a lot of the capital issues, structural issues that we've been speaking about. But the advice of our bankers was not to start marketing that bond at all, and rather to go another route.
Could you maybe give some background? I mean, the biosciences potentially is quite a big deal and should raise quite a significant amount of capital or proceeds. From a timing point of view, when we could expect something? Because you seem fairly far down the road on that.
Yeah, it is very advanced. So I think that's what I can share right now. So it will happen within this 6 months at the latest. That's what I can say. That's also what we said when we announced the disposal in September. We're going to complete it within the fiscal year, but it's very advanced. That's what I can share right now.
But you mean you will get the cash?
If it's very advanced, yes. Yeah. There's one over here.
You sound quietly confident about sildenafil, I think. Is that right? In the US. What do they do, and what sort of revenues are you expecting from them in the future?
I cannot share any revenue targets for that product at this moment of time. We just got the patent approved, and we're working with a number of different parties at the business plan in the US. So I can't share with you right now what is the potential. I think you can imagine if you just look at the population, though it's a very competitive market, but we have a very unique product with a unique dosing, that we should have good opportunities there. But it's too early. But I wanted to share at least that we have the patent before we go into the next stage.
Because I'm new to this company, I don't know much about it. What do they do?
Pharma leader.
No.
So it is a, let's say, equivalent of Viagra, but a special dosing. It's in the generic segment. They have a special dosing, tapping into special consumer needs that men have in terms of dosing. And they have developed this 18 months ago, and it's taken off already in other markets via other partners. Any other questions? If not, then thank you very much for coming today. Thank you for support and for your attention. Thank you.